Hello and welcome. Today we're working on our data analysis Excel basics course. We're going to work with stock and bond returns to calculate the returns and then some basic statistics on that. So let me show you what we're going to do. We're going to start with a data set and we're going to end up with a table that gives us lots of information, and then we'll do some stats on that table. Hello, my name's Jeff from Finally Learn, where I help you learn financial literacy. So let's get started with the learning. Let me show you a little bit what we're going to learn. We're going to duplicate worksheet and have growth formulas. We're going to do several of these functions that are brand new to you. And so let's get started with our data set. All right, our data set, here's our numbers, and sometimes you might not want to write over the data set or use that one. So what we're going to do is I'm going to copy this worksheet. So I'm going to right click and move or copy, and move to the end and create a copy. So now I have a complete another worksheet, complete separate worksheet that is the data set. So I'm going to now call this the table. I'm going to call that a table. Whatever you want to do that is fine. So here we have the years from 1928 all the way through 2019. We've got the annual returns of the S&P 500, that's the U.S. large stock index, so how well those 500 largest U.S. companies did. We have the 10-year Treasury bond, and we have the 3-month Treasury bill. So this is government debt, and then short-term government debt. So this is more, intermediate 10-year bonds. All right, so let's get started. Here's what we want to do. One thing, let's make it larger so we can see it easily. So let's make it, I'm going to make it like 200% so you can see it really easily. You can change whatever you want to, change the font size. So go ahead and start making a table that's very readable. Make this maybe 14, see how that looks. Yeah, very readable for you. And I'm going to size the columns where the width is easy to see the label. All right, now, one thing we want to do is I want to build a table here where I have the growth. What if you invested $1,000? So I'm going to put at the very top $1,000 because I'm going to point to that. I'm not going to type in a number anymore. But what if you had $1,000 and it was in the S&P 500 at the beginning of 1928? So I'm going to take the 1,000 times 1 plus, start of parentheses, 1 plus 43%. So what that's going to do is take the 43% times the 1,000, that's $438 return, plus the original 1,000, that's the 1 plus part of that. And so then what we have is, we have 1438, let's make it $sign. So this is stocks. If you invested in stocks, after year one, that 1,000 would grow to 1438. We're going to do the same thing with bonds and the same thing with the bills. All right, now how do we do year two? Well, year two is 1929, so at the beginning of 1929, that's the end of 1928. We're going to take the 1438 times, start parentheses, 1 plus. Now it loses money, 8.3%. So the account goes down a little bit to $1,318. So a little more than $1,300. Now, we should be able to copy this down. Now, there's a couple of different ways to copy. You can do Command C or Control C and then Control or Command V, and that would copy it down. Let's check our work. It takes the previous years times the current year return. Now, we want a way we can copy that down quickly. If you have your cursor, you see it is a outline, a plus that's an outline. If you go to the bottom right hand corner, it changes to a solid plus, and you can drag it. You can left click and drag. That's one way of doing it. Now the faster way of doing it is if you'll get to the bottom right and then double click, and then it sends it on down. Let's check what the final total is. Now when you get down here, these hashtags, you think, oh, that's an error. That's not an error. It just doesn't show a partial number. So we need to size column F. I'll double click. So that $1,000 grew to $5 million, $5,022,000. All right, so that's fantastic. That's why the stock market over a long period of time has been an excellent, a fantastic investment. Well, let's say that you care about returns, about bonds. It's safer. What kind of return would you have if you had bonds? Same thing. So we take 1,000 times 1 plus the 0.84%. We'll make it $ here. And we're going to do the 1,008 times 1 plus the 4.2%. So what happens in bonds, you start with 1,008 and then you end up with 1,050. If we copy that all the way down, you have 80,000. So that 1,000 grew to 80,000, which is 80 times, which is great, but it pales in comparison to the stocks, which is $5 million. Now let's continue. Let's do the bills. Bills are short-term money. It represents like a savings account or a money market fund. So let's take the bills. What if you had $1,000 times 1 plus, you made 3% that first year. Let's go ahead and make it a dollar amount. So then as we copy it down, it all becomes dollars. The 1,030 times, start parentheses, 1 plus 3.16. All right, I made an error in my formula. My formula, I did a plus. So let me start from scratch again. So it is 1,080 times, 1,030 times 1 plus the 3.16. So that's 1,063, and then all the way down, copy it, and this looks like it'd be correct. So now it's $20,000. So here's the message. If you invested in stocks, it's $5 million. Treasury bonds, 80,000. Treasury bills, 20,000. So the risk and reward kind of go together. All right, now we have a table. We want to build it where it looks very nice. And so I think we're finished with the table portion. So let's do this. Let's highlight it. And to go across and down, I don't have to drag it. So this would be Control-Shift, arrow across and arrow down. I'm on the Mac, so it's Command-Shift, arrow across and arrow down. So I selected the entire column. Let me show you a trick how to do this. I'm going to format the table where it's nice and pretty. I'm going to use on the home ribbon, Format as Table. I'm going to click on that, and I'm going to pick one that I think is really nice. And I like blue, so let's go with blue here. You can pick whatever color you want. My table has headers. I did not include that top 1,000. I'll get to that in a little bit. So you see that this is a table. So if I select outside of the table, I do not have an extra ribbon. When I select inside the table, look, I have a contextual ribbon that says, oh, you have a table, do you want to work with that table? I don't want to keep it as a Excel defined table. I want to take it off that table. And so it's not very obvious, but on the table ribbon, it says convert to range. Convert to range means remove the table, not formatting, but remove the table aspect in Excel. This table is a defined table in Excel. I want to convert to range. So yes, you want to be normal text, yes. And I've taken it off the table, but the formatting stays the same. Now here's what's helpful about this. I think it looks good. It makes it easy to read. Somebody can see, oh, 1958, I can follow all the way across because it has alternating row colors. All right, so that's a little trick. Put it as a table and then take it off the table. Use the convert to range, which is not obvious, but that is converted away from table. So let's finish up the top part of this. I'm going to make this $. And we can do this so that the top here is the annual returns. The annual returns, and I can make it where This is merged and center. So these are the annual returns, and this is the growth of the $1,000. I can make this merge and center so you can see clearly what's going on. This is $1,000. Now I'm going to grow $1,000. I could change this to $1. It's not near as impressive. I can change this to $10,000, and the growth continues. So 1,000, I'm just using 1,000 as a number. You can see the growth that happens. All right, now once we're finished with this, let's do some calculations based on these numbers. What does this mean? Stocks has grown to 5 million, bonds 80,000, and T-bills, Treasury bills, or essentially like your bank account, savings account, is about 21,000, looks like. All right, so let's do another tab. Let's just create another tab. So here's a sheet that we're going to use. Let's make it once again 200%, so we can make it as nice and readable. All right, so let's do things like the years are 1928 to 2019. 1928 to 2019. So how many years are we talking about? Well, one thing I want to do is we're going to do with several formulas. We're going to use the years, and we're going to use the stocks and the bonds and the bills. So let's name these ranges. Let me start naming these ranges so we can use these in formulas rather than the cell, the range, which would be something like B95 starts at B4 to B95. That gets a little tedious, so let's name this whole column of dates, let's name it years. So I'm going to do Command Shift down, Control Shift down if you're on Windows, and up here right beside the formula bar, let's call it years. So years is now the named range, and enter. So if I ever need to access that range, I can call it years rather than B4 to B95 or whatever that is. Same thing with S&P 500. I'm going to do Command Shift down, and this is stocks. Enter. Bonds, I'm going to select that entire row and call that bonds, and the last one is going to be bills. So named range is going to be helpful, and it'll be faster to do our formulas once we set that up. All right, so here, how many years are we talking about from 1928 to 2019? Well, that's going to be a count function. So let's do count, and we just need a value. Our value is going to be years. How many years do we have? Well, it's 92. A lot of times people take the difference, 2019 minus 1928, and you say, well, that's 91 years. It includes 1928 and 2019, so it's inclusive, so that's 91 years. So let's do something like, well, how many years in the 2000s? So you can say, let's do 2000s. How many years are in the 2000s? Well, we can use a logic. By the way, I'm going to put a formula called formula text, so we can kind of point to and see what's going on with that cell. So all we're doing is count and years. Now, it doesn't work unless you name that range. Otherwise, you'd have to use B5 through B95 or whatever that range would be. So how many years in the 2000s? Okay, we're going to count the years since, after 1999. So we're going to use a function called COUNTIFs. Now I'm going to use my formula builder. So I'm going to start looking for COUNTIFs. There's several here, COUNTIFs. And you need a criteria range and a criteria 1. You can do a second criteria, but we don't need that. We're going to do criteria range is years. And you see when I type in years, it gives me 1928, 1929, so it knows that is an array, a range of information. my criteria 1, I can do something like has to be greater than 1999. So anything in the 2000s. So I'm going to hit done. Now look what happens. It counts 20 years from 2000 all the way to 2019 is 20 years. And the formula is COUNTIFs years, and it puts in double quotes, greater than 1999, double quotes. So if you use the formula builder, you don't have to remember to put the double quotes. So that's how it works with the COUNTIFs. So we've counted all the years in the 2000s and all the years total. We got 92 years, and we have the years in the 2000s are 20. All right, next thing we want to do is let's do an average. Okay, so let's do an average of, we'll do stocks, and we'll do bonds, and we'll do bills. All right, so if we just did an average, or the mean, well, that's going to be simple. We're going to do the formula builder. Let's just type in average. And the average is going to be, it kind of suggests something. We don't want that. We want an average of the stocks. So stocks average is going to be something like 11.5%, so 11.57. If we copy that across, what does that do for us? Well, it still is calculating the stocks, so we just have to change and edit, make this bonds, and make this bills. All right, so the average. Now this is not the way you report the average return, but this is the average of all those numbers of the stocks and the bonds and the bills. So what you see is this is the simple mean, or the arithmetic mean, and this is not the way you report returns with investments, but that's the average. So let's do an average for the last 20 years. So let's do, this is average. We're going to use an AVERAGEIFS. So average last 20 years. Okay, so in the 2000s. So how do we calculate this one? This is going to be an AVERAGEIFS. And let's see what we need. We need average range, we need the criteria range, and we need the criteria 1. All right, the average range, we're going to average the stock investments based on the years. So we'll type in stocks and then years, and the criteria is it has to be greater than 1999. So anything in the 2000s. So what we have, how is the returns in the 2000s? Well, in the last 20 years, the stock market returned just a simple average of 7.59%. If we copy it across, that's going to return the stocks. All we have to do is change stocks to bonds and change the stocks to bills. And we have the returns. Bonds is about 5%, and Treasury bills about 1.7%. All right, let's do the next one. Let's do the 5 largest, and we'll do the 5 smallest returns. One of the things you're worried about if you own stocks or bonds is how big the numbers might be, but how small they might be, how negative. So we might say, hey, look, this is great. Here's the 5 largest years of all these stock returns and bond returns, and then we'll also do the 5 smallest. All right, I'm going to insert a column here. I'm going to insert a column because I want to do, well, no, that's fine. I'll do this. I'm going to do 1, 2, 3, 4, and 5. So these are going to be the 5 largest returns. So on this one, we're going to use a function called large. Now, if I want the single largest, that's the max function. But the large function will give me, we have an array, and then we need to figure out the which one is the first or second or third or the fifth, so on. So the array is going to be stocks, and I want it to be the first one. That's why I put a little helper column here, so it's the number 1 and done. So the largest return of all those years is 52.56. So 52.5% return for 1 year, all those 92 years of stock returns. Okay? Now, I want to do stocks, bonds, and bills. I'd like to be able to copy them across or down. With stocks, I know we can copy this down. Let's see about how we can copy them across. Here are the 5 largest ranked in order. So the 5th largest is a 43% return. Now, if I copy it across, I'm not going to have the right number. I'm going to do bonds and copy it the B13. I want to point to the A13, and that's good enough. So the largest bond return is 32.81%, and then copy it down the top 5 largest bond returns, smaller than the top 5 largest stock returns. All right, the last one is going to be bills, and I want to point to the number 1. So the largest you'd ever have on Treasury bills was 14%, and then it dips down into close to 10%. So stocks return more than bonds, that return more than bills. All right, we do the same thing for the 5 smallest. So I'm going to copy and paste just so I can have my formatting. So this is the 5 smallest. I'm going to use a function called small. So instead of large, I'm going to use small. So at the very beginning, I want a return on stocks, and I want the absolute smallest return for stocks. Now the problem is the smallest return is a negative number. The worst return in all those 92 years is a 1-year return of almost 44%. So that's a challenge. And your worst returns are 36%, 35%, 25%. So if you invest in the stock market, you're worried about these losses. Same thing, we're going to do bonds. So type in bonds and then point to the number 1. So the smallest bond return, you've lost 11% in 1 year. So people that are risk adverse say, well, I don't want to lose money, right? And so therefore they may do more bonds rather than stocks. The last one here on bills, we're going to do bills and point to the number 1, and that way we can copy it down. So the worst return is a tiny 0.03%, and 0.05 is in the top 5 smallest. I need to make this smallest. Okay, so the top 5 largest, the 5 largest returns, and the 5 smallest returns. People that are worried about the stock market are worried about these returns. So let me show you the way you actually calculate the return. So what is our compounded annual growth rate? Now this is called CAGR. Compound annual growth rate. We're going to use a function called rate. We're going to use a function called rate. Now, this is a time value of money function, but let's calculate what is the rate of return over that entire period of time. So we're going to use a rate function. Now you're going to have to kind of pay attention, make sure you understand what's going on this. The number of periods, we're going to point to the 92. We've got 92 periods. The payment is going to be 0. We just started with $1,000. Our present value was $1,000. And so typically what happens is present value and future value cannot be the same sign. So we're going to have to say, well, we paid 1,000, and we can point to that. Let's point to the 1,000 on that table. So the 1,000, and we'll make it a negative 1,000. Otherwise, we'll have an error. And we'll point all the way to the bottom and said that 1,000 over 92 years grew to $5 million. And the type, if you look down here, the payment happens at the end of the period, is 0. There's no payments, it doesn't really matter on this. And we could guess what that number would be, but let's just hit enter. So here's how you actually calculate the rate of return. There's one way. So to report this, how well has the stock market done over the last 92 years? Well, the S&P 500 has returned 9.71%. That's the official one. Up here, this 11.5% is just a simple mean of those returns. It doesn't count that the account went up and down. And this is the way, if you got a 9.71% return, your 1,000 would grow to the $5 million number. Okay, so let's do this a couple more times. We can have it where we could copy this across, but let me do it a couple more times so you understand what the rate is doing for you. All right, the number of periods. Now, if you want to, we can type this in, 92. There's 0 payments. The present value is negative 1,000. The future value, we do want to point to that number as 80,000. So this is the bonds return. The payments happen at the end of the period. There's really no payment, so we don't have to do that. And we don't have to guess at all. It can calculate for us. And so the return is going to be something like 4.88 for bonds. Now bills are going to be the lowest rate of all. All right, let's do the rate for the bonds. The bills. So the rate is going to be, the number of periods is going to be 92. I'm going to point to the 92. The payment is 0. The present value is going to be a negative 1,000. Start at the very top. We're going to make that a negative 1,000. The future value is going to be a positive, and that's that $20,000 number. We can omit this. Their payments happen at the end of the period, but there's no payments here. And hit done. So 3% is 3.36 is the growth rate. So why would somebody invest in bonds? Because of the higher return. Yes, there's more risk. One of the things we want to look at, let's look at the risk. And we can measure this with standard deviation. So standard deviation, if you start looking at standard deviation, P is for the population. This is the entire population of the S&P 500 returns for those years. So let's calculate, and all we have to do is standard deviation of stocks. And this would be a percentage. So the risk, and let me copy it across and just edit it for bonds and bills. And you can see, based on the standard deviation, that yes, stocks are more risky, but they have a higher rate of return. Bonds are less risky. Bills are less risky. But remember, this went from 5 million to 80,000 to 20,000. So the risk and return go together. One of the basic things in finance is risk and return go together. It's hard to have a big return without additional risk. All right, so that's how we build tables and calculate some returns on this. One more last thing as we finish up. Let's take this table and let's do a rank. Let's rank the top, the returns 1 through 92. So let's do a rank, and let's call it stock rank. So where does, if we look at this first year, 43.81%. That's pretty good. That's fantastic, right? That's not just pretty good. That's great. That's a great return. How does that fit in the entire 92 years of stock returns? Okay, so let's get started. We're going to use the rank.eq. So if there's a tie, it would show both at tied for third or whatever. You can use rank average, but let's get started with the rank here. So rank. Now, one of the things that happens is if you look at rank, it says there's a function called rank, and you think, oh, that's simple. But it says this function is available for compatibility with Excel 2007 and earlier. So this is an old function. They've kept it in Excel, but you probably shouldn't use it in the future. This is because you might have some old legacy spreadsheets that you need to make sure they still work. But we'd use a modern rank average or a rank EQ. I want to recommend we use rank EQ. It won't matter, I think, on this one because the numbers are not going to tie. So rank EQ, what's the number? We're going to look at the 43.81%. The reference, or is the array, so in stocks. So how well does 43% fit in stocks? And what's the order? The order is going to be descending is going to be 0, and then ascending is you put a 1 or any other non-zero value. So I think we want to put 0 here. So this one says, hey, that 43.81% is the fourth best of all those 92 years. We can double click and copy it down. Well, it didn't work, so let me drag it. Oh, because it's not actually next to the table, so we have to drag it down so we can find what is the single best return. The single best return is 1954, that 52%. We already calculated that. Let me hide this. We already calculated that 52.5% is the number one, but we can rank things and then we can sort by the rank or whatever. All sorts of different ways to do that. So that's how we finish that up. You're going to have two things. We have a table that shows the growth of $1,000, and we can change that number. And then we can also do some information here, and so I'm going to call this some stats, some basic stats on the largest, smallest, the rate, the risk, and then simple averages, and then the counts. All right, that's how you do exercise 2. Thanks for watching.